Welcome back to Dividend Cafe. This is Brian Szytel here in on Monday, standing in for David, who is en route from DC, Washington, DC, back into the city, into New York, after a meeting there on in Washington. But overall, fairly quiet day today. So I'll run through things here for you on Dividend Cafe. We actually closed basically at the worst levels of the day. The Dow ended up closing down 19 points, but we were up about 250 points in the morning, and just sort of gave all of that back, but not necessarily on a lot of anything bad, just sort of a lack of, frankly, news. The S&P, though, and the Nasdaq still closed at record territory, so just barely. They were up. Dow was down 19 points. S&P was up 8 points. Nasdaq was down sorry, about 80 points on the day. So overall, pretty quiet day. There was a decrease in interest rates across the yield curve today, particularly on the long end. I think some of this had to do around a political event in Japan that I'll walk through. But you had 10-year yields today close off about four basis points of the day. We closed 438 on 10-year. So there's your around the horn, at least on some of the broad market action for the day. But the path of least resistance essentially remains higher in markets. You've got a benign or less aggressive trade paradigm that is priced in. You just have a lower volatility backdrop that is into markets now. You've got earnings that are coming out and are generally positive. And you've got some depreciation that was included in the reconciliation bill out of Congress, and then likely some lower interest rates that'll come through towards the end of the year, and then also a deregulation backdrop as well. So all things being equal, the market is tilted more towards the upside. That all said, it's now more about just where valuations already are. And of course, there's comments in there today about what will come out in earnings. I don't suspect something will blow away these numbers, but I do suspect that they'll hold in. And just to that point, so far, only 12% of S&P 500 has reported earnings. So there hasn't been a whole lot out yet. But what has come out has been better than expected. We've got about 5.6% EPS growth. We were thinking it was going to be something at 4.8. I'll call that pretty much in line. But of the companies that have reported, 83% have beat earnings. And that's above what we've seen historically, around 77%. So more beating earnings and by a slightly larger margin, although all that's doing is essentially supporting current market levels. It's not necessarily expanding them. The other thing I think that is interesting is we look at things like bull-bear ratios and just different metrics that give us a sense of where sentiment is and where investors are. And there's a city panic euphoria index that was created 10, 15 years ago. And it also hit the highest level. So there is some good stuff all being priced into markets here at these levels already. We've talked about the top weightedness of the S&P 500, how it's over a third now technology. And if you include sort of technology adjacent industries, it's more like half of the index. But what we sometimes don't talk about is the defensive sectors. So of course, those things are a tautology. If you think about an overweighted tech sector, then the other sectors have to be underweighted at this point. But if you look at defensives, to put it in perspective, what is usually, say, a 30% weighting in the market is only about 15% now. So it just goes into being selective, looking at valuations, and those things are very important. And to that point, if you look at something like the semiconductor component or sector, while this is a very hot sector and actually has come up about 20% here, it's just back to where it was a year ago. So if you invested in this sort of hot sector, you're basically at a 0% return over the course of the 12 months. And again, it goes back to the point of just the starting valuation really matters. So moving through, that was sort of a market recap there and giving you some insight. But if you look in the economic front now, we've got a pretty quiet calendar, both today, which is Monday, and tomorrow, which is Tuesday. And we don't really get into much information until we get into Wednesday and Thursday. We'll have initial jobless claims. We'll have some PMI data. We'll have some new home sales, some durable good orders on Friday. So quiet start to the week, and then we'll get into more information into the latter part of the week. That said, if you just look at where labor is and this 221,000 jobless claims number that we seem to be hovering around now for about a month, it's just a very balanced labor market. And I think we've spoken about that, but to make another note of it today on the economic front, this is not an employment picture that is falling out of bed yet. So the economy, the U.S. economy continues to be resilient. Public policy today, there was news out of Japan. Prime Minister Ashiba lost his governing majority just by a narrow margin, really. He needed 50 seats, he kept 47. But, it's the Japanese voters essentially suggesting that maybe the porridge was just right when you had a deflationary environment and 0% interest rates. You sort of get addicted to that as an economy. I think there's part of the U.S. economy that is also addicted to that. And I think that's why a lot of the housing market remains frozen, because it's assuming that interest rates will go back to these low levels. And I don't know that they'll go back to zero, but potentially then go lower than they are now. But in Japan, it's a different story. You've got 30 years of deflation. You've got just inflation now and positive growth, and frankly, positive risk assets in the Nikkei, in the stock exchanges there for the last couple of years. And so the fact that the political side may be turning over is a little disappointing. There's been a lot of talk about the yen and its weakness versus other currencies. It weakened a bit today as well. But if you look at it where it's been over the last couple of years, it's essentially been floating around 140 and 150. So same thing with the dollar. When you get the media saying the dollar is weakening, in perpetuity or something like that, they're just talking about the last 3 to 6 months. There is some talk. I know Secretary Lutnick was out today talking about confidence in a deal with the EU. Again, if you remember, there was a self-imposed tariff deadline of August 1st. And that's obviously a huge trading partner for us and for the U.S. And supposedly there was some momentum or some deals to be had there, some confidence about them. I'm always a little reluctant to spend a lot of time going into that stuff because it's just so volatile on what actually will happen and what will just be spoken about. But there you have it there. Going into the housing side of things, we had single-family housing starts at an annual pace of 883. That's 883,000. That's technically the lowest level that we've seen in about a year. We also had a decline in permits too, so that's a forward-looking indicator. And again, housing remains stuck. But what we are seeing is this dichotomy between single-family, which is anemic, both on existing sales and new builds and pretty much across the board. Again, interest rates play a big part of that. And then also on the multifamily side, which has actually been pretty decent, there's still a need for people to have a roof over their head. And whether that's in the rental market, in the multifamily space, so be it. And we've seen a dichotomy and a delta between those two numbers spread out even more in the housing side. On the Fed front, again, not a lot of data out today. They're in a quiet period here before a policy. I will say there's about a 24% chance for a third rate cut now before the end of the year. There's still 50 basis points priced in. Again, that's basically pricing in September and December. But we feel pretty confident, at least from the change in rhetoric around the Trump-Powell narrative of Trump thinking, he may want to fire Powell in one press conference and then maybe not in another. I feel pretty confident that Bahnsen probably talked some sense into that, because even just from a legal perspective and a timing perspective, we're only talking about a short period of time. What would be the upside? Very little. The downside would be collateral damage on market volatility and things that would be unsavory for the president's administration to deal with. And so I believe Powell will basically fill out his term and then get replaced by one of the top Fed governors that are in the running now, call it Warsh or Waller, one of those. But moving into oil and energy on the day, again, not a lot of news out. Oil has been positive. Midstream, particularly last week, was positive. S&P was up a little bit too, but midstream was up about 1% last week. S&P was only up about 0.5 point, but that was with oil down. So, as far as what midstream was always supposed to be, which is not tethered to the volatility of the commodity price changing, but the amount of volume that is going through those pipelines, it has actually been performing obviously very, very well for about 3 years now, 3 straight years. Question in there today, is a version of some things that we've gotten before, but it's a very astute question from a great client asking about if tariffs are inflationary and the fact that they're basically just shifting supply and demand dynamics versus actually creating a monetary event, which is more dollars chasing few goods and causing an increase in prices. And the answer to that is that's exactly right. The inflation, the definition will always be a monetary phenomenon. So the fact that a tax might increase the price of a good or even a service, at least you could say temporarily or in a vacuum, meaning other sectors may not be affected. It's hard to call that broad-based inflation, number one. And if you look at the formula of it, while it may change some of the supply and demand imbalance, ultimately, if it's destroying or hurting the supply side because higher taxes decrease productivity rather than increase productivity, then I think you could get monetary inflation out of it. But just in and of itself, a tariff and a tax isn't inflationary in and of itself by those definitions, at least formulaically. Um, so there you have it for today. Again, today was a bit of a quieter day, so I'm keeping it for pretty succinct for today. I'll be back with you tomorrow, which will be Tuesday on Dividend Cafe. We'll obviously have for clients the weekly portfolio holdings report on Wednesday. Then we'll have a longer version of Dividend Cafe on Friday again. And again, like I said, there'll be more in the economic calendar as the week goes on. But there's your around the horn. We had an up morning give way to basically a flat to slightly down day on the stock market. But nonetheless, things are moving forward. And I still encourage everyone that's watching and listening to please reach out with questions. Obviously, we love to get them. They're fun to answer. And I do think there's a value added to other readers seeing what's on folks' minds. So please do. With that, I will let you go. I wish you a lovely evening, and we'll be back with you soon on Dividend Cafe. Thank you.